Sir, as per the constitutional provision, that is highly elastic revenue sources are under the jurisdiction of union or the central government, like foreign aid, deficit financing. As a result, with the passage of time, states in India have become more and more dependent on the center for financial help. What are your views on this, as you were mentioned earlier also? So how you can raise the extra sources of revenue for the states? It means, is the union government should allow the states to borrow from foreign funds or take amount of loans from the developmental banks, like?
You see, the founding fathers of Constitution had thought of the issue in a very, very systematic manner. In the literature on fiscal federalism, you come very clearly, which shows that there are three major functions of the government: macroeconomic stabilization, redistribution of incomes, and allocation of resources between the public and private sectors and among various services within the public sector.
Yes.
Now, macroeconomic stabilization is predominantly a central function. I didn't say exclusively, predominantly a central function. Now, which basically implies that the center has a major responsibility to see that volatility in prices is contained, employment is increased, and then macroeconomic variables are set in motion for a faster growth, etc., etc. So the predominant responsibility is that. And if you allow the states to go and borrow from anywhere and everywhere, then there is no control over the overall debt situation in the country, which is a very crucial variable to determine the macroeconomic stability. And again, deficit financing, you said, these are not revenues. Deficit financing is source of financing. It is not revenue. Means you have to earn. This is an unearned. There is no earning here.
Yes.
And so the point is, so elastic sources of revenue are income tax. That is the only major elastic source of revenue.
Okay.
Here, so obviously, when you are saying that deficit financing, even the center, in fact, there is always this case when the markets fail, the governments have to come and then intervene.
Yes.
What do you do when the governments fail? We had a massive deficit financing that was done before, and we got into a major, sort of balance of payment crisis in 1991. And thereafterwards, there has been a lot of thinking on this. And then, of course, the Fiscal Responsibility Budget Management Act came in 2003 to tell the central government that you also should control your deficit. It is not that you can go ahead. But before that, before 91, there never used to be a terminology in our discourse called fiscal deficit.
Seriously.
This, they used to say budget deficit.
Budget deficit, yes.
And the budget deficit is not fiscal deficit. Budget deficit is, you borrow from the market, and whatever is uncovered by the borrowing from the market is actually borrowing directly from the Reserve Bank of India by issuing short-term, treasury bills.
Treasury bills, yes.
And it was automatic. So there was automatic monetization of the deficit that went on. And that went on. And that is one of the reasons why, whatever is not covered, I have an ambitious plan of spending, and so the Reserve Bank will print money, and then you did not look at the consequences in terms of inflation.
Seriously.
And then what happened was that in 1990s, this discussion went on, we can't be letting it happening. In 1997, there was an agreement between the then Governor of the Reserve Bank of India, who was Rangarajan, and then Minister of Finance Secretary, and that was Montek Ahluwalia. There was an agreement that in future we will not do automatic monetization of the deficit. We will get rid of this entire business of issuing treasury bills and automatic monetization.
Yes.
And so from 1998 onwards, you don't have automatic monetization. Yes. So even the deficit financing can't be done. The point that I'm trying to make is even the center cannot do deficit financing as it wants.
Yes.
And in the earlier, it can borrow from the market. But if you borrow from the market, the yield goes up, and if the yield goes up, you have to pay a much higher rate of interest.
Yes.
So there have been certain amount of checks and balances that have been put in place.
Yes.
But at the same time, And of course, 2003, there was the Fiscal Responsibility Act, which basically said that you've got to really control your deficit. Government of India has been flouting. And possibly the solution to that is another institution. In fact, in many of the countries, they have what is called Fiscal Council. Okay, now, for example, in the United States, you have what is called the Congressional Budget Office.
Yes.
In many other countries, you have what is called the Parliamentary Budgetary Offices. In UK, you have what is called Office of Budget and Accountability. These are created by the Parliament to provide a check against the government's decision to go on really, doing the deficits, incurring deficits, and then monitoring them. Control and audit then comes after the event is over. But this is on the concurrently. They start with evaluating your budget forecasts, saying whether your budget forecasts are right or wrong. And when some governments comes up with the major schemes and then makes announcement of the schemes, nobody actually budgets these schemes. This Parliamentary Budget Office actually estimates what would be the expenditure involved in actually carrying out these schemes. You said Namami Gange, it has gone on and a lot of money has been put in the drain. And we don't know what is the total amount that is really required to clean up the Ganges and what are the various things. But we have been spending taxpayers' money on these. And then the third thing is monitoring the fiscal deficit of the government and saying that, look, you can't do this.
Yes.
But that has not happened. And in fact, there is a recommendation in the 14th Finance Commission basically asking the government to move the parliament to appoint a fiscal council.
Yes.
Okay. Now, I mean, these are all institutions of, the basic question that I asked. When the market fails, the governments intervene. When the governments fail, what do? You need to have the institutions to create checks and balances in the system. And that is precisely what we had said. But in any case, as I said, it is not that the government of India has all the things. And the state governments have to really manage within whatever is available. And that is the reason why you have an independent institution called the Finance Commission, which comes every 5 years and then basically examines the finances of the center as well as the states and sees what is the reasonable amount of money that can be transferred to the state. And to the credit of successive governments in India, one of the major things about the Finance Commission is that it has been respected, its mandate has been taken, and then its recommendations have been accepted.
Yes,
for the most part. I mean, by and large, there have been one or two exceptions, but by and large, the basic recommendations and the transfers have been accepted.
Yes, I think after the change in the organization of Planning Commission to Niti Aayog, the relevance of Finance Commission has come up, and that's a great, because we have a constitutional body. And that's
not really the case. I'll tell you, it is not the relevance of the commission has come up. Actually, it resurrected the revolution. You see, if you go back and look at the history,
yes,
when the third Finance Commission came into picture, the Finance Commission was not asked to look at only the non-plan side. I mean, it was asked to look at the totality.
Yes.
But by that time, the Planning Commission has become a reality, though it is not a constitutional body. It's a, it was created by a cabinet resolution.
Yes.
Now, but then what happened is that the government asked the member secretary, the serving officer of the government, member secretary to write a note of dissent. The main recommendation was that yes, Planning Commission exists now. We will assess the entire thing. For plan side, we will give something like, we will give 75%, we'll take into account, 25% recommendation, grant they can give. The Planning Commission can give. This was the main recommendation. But the note of dissent is that we should completely desist from looking at the plan side at all together, allow the Planning Commission to do. And when that happened, that is the only time in the history of this country that the Finance Commission recommendation was rejected. And the note of dissent of the member secretary was taken. And subsequently, for all the Finance Commissions, the term of reference basically said you look at only the non-plan expenditure requirements. Until the 14th Commission, where somebody forgot to put that word non-plan. So the basic point that I'm trying to, so now, So, in fact, you see the idea about looking at, sort of not looking at the idea about looking the entire thing holistically came even before the Planning Commission came into picture. Planning Commission was abolished because the terms of reference was given much before the Planning Commission was abolished.
Yes.
And it's a different thing that the Planning Commission is abolished. So, in other words, the Constitution envisaged the Finance Commission to be the only body to make the transfers.
Yes.
But then the other things have developed. Discretionary transfers came in. But then with the abolition of the Planning Commission, at least the general purpose transfers, came to be the entire prerogative of the Finance Commission.